Pets.com was once a rising star in the world of e-commerce. Founded in 1998, it set out with a bold and simple mission: to sell pet food, supplies, and accessories online. The concept sounded brilliant. With the internet booming and more people using it to shop, the idea of bringing pet products to customers' doors seemed like a winning formula. Early on, Pets.com attracted a lot of attention, which seemed to be exactly what they needed to make it big. In 1999, the company raised millions of dollars from investors. The excitement was palpable. Investors saw a huge opportunity in the online pet market, and they were ready to support it. Pets.com quickly expanded, hiring hundreds of employees, buying warehouses, and investing heavily in technology and infrastructure. With all this momentum, the company seemed unstoppable. Their website became popular, and everyone seemed to know about their adorable mascot, the sock puppet dog, which appeared in their famous TV ads. The company's flashy marketing campaigns and catchy commercials helped them attract even more customers. But as the company grew, so did its challenges. Pets.com's leadership didn't take enough time to figure out how to run a sustainable business. They rushed to expand, opening up new markets and hiring staff, without fully understanding the costs involved. They were trying to grow too quickly without laying a solid foundation. Their approach was flawed. Instead of focusing on building customer loyalty, they spent an enormous amount of money on advertising to get people to visit the website. While this brought in traffic, it didn't translate into consistent sales. People might visit once, but they weren't coming back regularly. Additionally, Pets.com had a major problem with their pricing strategy. They sold pet food and other items at low prices, but the shipping costs were high. This created a gap between how much they were selling and how much they were spending to fulfill those sales. The company's core business model just didn't work. The customers didn't stay loyal, and the high operating costs kept rising. Why did the cat join the online pet store? Because it wanted to be the perfect customer. Despite all the excitement and the big investments, Pets.com's business model was not built for long-term success. In the world of e-commerce, there are two main factors that can make or break a company: pricing strategy and customer retention. Unfortunately for Pets.com, they struggled with both. First, let's talk about their pricing strategy. Pets.com tried to compete by offering pet products at low prices. This sounds like a good idea, but there was a catch. The cost of shipping pet food, heavy bags of cat litter, and large pet toys was very high. Pets.com offered free shipping, but they didn't make enough money from the product sales to cover those costs. Every time someone ordered, the company ended up losing money on shipping alone. In simple terms, they were selling items at a loss. This is not a good business practice, especially when a company is trying to scale and expand. Then there was the issue of customer retention. Just getting people to visit the website wasn't enough. To keep the business running, Pets.com needed repeat customers. However, customers didn't return to buy more pet supplies. The company didn't create a solid reason for people to keep coming back. Their low prices didn't offer enough value when you consider the high shipping costs. It wasn't like they were building a community around pets or offering personalized services to keep pet owners coming back. Without a way to keep customers loyal, Pets.com's sales slowed down after the initial burst of interest. On top of this, the company faced strong competition. While Pets.com tried to dominate the online pet market, other competitors like Amazon and smaller pet stores started to make their moves. These companies had a better understanding of the market and were offering more competitive prices with lower shipping fees. In contrast, Pets.com was bleeding money and couldn't keep up with the competition. To make matters worse, Pets.com was burning through its cash fast. They had raised millions, but without a strong business model, the money was going out faster than it was coming in. This led to serious financial problems, and soon they couldn't sustain their operations. Why did the dog start an ad campaign? Because it wanted to be the bark of the town. While Pets.com's business model was already in trouble, the company decided to throw even more money at their marketing efforts. They believed that the key to success was getting their name in front of as many people as possible, hoping that would solve all their problems. Unfortunately, they were wrong. Their aggressive marketing strategy ended up hurting them more than it helped. One of the biggest mistakes was their massive TV advertising campaign. Pets.com spent millions of dollars on TV ads featuring their famous sock puppet dog. These ads were everywhere, and while they got a lot of attention, they didn't do much to drive actual sales. The company thought that just getting people to know about their brand was enough, but they didn't focus on converting that awareness into real customers. The ads were catchy, sure, but they didn't communicate why people should buy from Pets.com instead of a competitor or a local pet store. The problem was that Pets.com didn't have a clear, compelling message that resonated with customers. Their ads were fun and memorable, but they didn't address the core issue. Why buy from them? With no solid product differentiation and no loyalty-building strategy, the commercials were just noise. People would see the ads, but they wouldn't remember why they should care enough to visit the site and make a purchase. And it wasn't just TV ads. Pets.com also spent money on print ads, radio ads, and even sponsorships for events. The problem wasn't that they were spending money on advertising. It was how they were spending it. They didn't target the right audience or create the kind of campaigns that would actually build customer relationships. Instead, they tried to build a brand without focusing on what people needed or wanted from an online pet store. On top of that, their marketing efforts were rushed and lacked strategy. They focused more on getting attention than on creating a lasting connection with their customers. This approach was expensive and ineffective. By the time they realized that their marketing wasn't leading to consistent sales, it was too late. They had already burned through a huge chunk of their funding. Why did the computer go to the vet? It had a bite. At the same time Pets.com was facing these internal challenges, the world around them was changing fast. The late 1990s and early 2000s saw the rise of the dot-com bubble, a period when internet companies were being overvalued and investors were eager to throw money at anything that had .com in its name. Pets.com, like many other companies at the time, benefited from this wave of optimism. They received large investments, and their stock price soared even though the company wasn't profitable. However, the bubble couldn't last forever. In 2000, the dot-com bubble began to burst. As stock prices for internet companies started to fall, investors began to get nervous. The excitement around online businesses quickly turned to fear. Pets.com, which had been riding the high of the dot-com boom, was now caught in the crash. They had been operating under the assumption that the internet was the future and that e-commerce was going to take over the world. But once the bubble burst, it became clear that many of these companies had been overvalued and lacked solid business models. Pets.com's stock price took a massive hit. Their valuation dropped drastically, and investors began pulling out. The company was no longer able to raise the money it needed to stay afloat. This was a huge blow for Pets.com, as they were already struggling with their business model and cash flow problems. They had been relying on the constant influx of investment money to keep their operations running. But once that money dried up, they had no way to continue. The burst of the dot-com bubble also caused a shift in investor behavior. No longer were investors willing to take big risks on companies that weren't making money. They started demanding that businesses show real profits and a clear path to sustainability. Pets.com, with its unsustainable business model, couldn't meet these expectations. As the financial pressure increased, Pets.com was forced to shut down in 2000. Their failure was not only due to poor management, but also the larger economic changes brought on by the dot-com bubble's burst. Why don't pets ever make good business partners? Because they always want to pause in the action. Pets.com's downfall wasn't just about bad decisions or the market crash. It was also about their inability to adapt. In a fast-changing business environment, especially in the early days of the internet, companies had to be flexible and adjust to new challenges. Unfortunately, Pets.com failed to do this, and it ultimately cost them everything. One of the key problems was their focus on the wrong priorities. They were so determined to be the biggest and the most visible online pet store that they didn't pay enough attention to the basics. Instead of focusing on creating a sustainable business model, they spent too much money on marketing and expanding too quickly. They should have been building strong relationships with customers and finding ways to improve their product offerings. But instead, they were simply trying to be everywhere, hoping that their brand recognition alone would keep them in business. Moreover, the company did not respond quickly enough to the changing market conditions. The internet was evolving, and consumer behavior was shifting. People were becoming more selective about their online purchases and began to shop around for the best deals. Pets.com didn't adjust their pricing strategy or their offerings to match these new preferences. Competitors like Amazon, which had a more solid e-commerce foundation, were able to offer lower prices, faster shipping, and more customer-friendly services. Pets.com didn't keep up with these changes, and they failed to build the customer loyalty that would have helped them survive. Another big issue was that Pets.com couldn't scale efficiently. They invested heavily in infrastructure, but the reality was that their business model simply didn't work for large-scale growth. The cost of shipping heavy items like pet food and litter was too high, and they didn't have the margins to support that. Unlike some of their competitors, Pets.com couldn't manage their supply chain efficiently or find ways to cut costs. This left them with a business that couldn't grow profitably. In the end, Pets.com's failure to adapt to market changes, improve their business model, and focus on what mattered most led to their collapse. They had all the hype and visibility, but without a solid foundation, it was only a matter of time before everything fell apart. Why don't skeletons run businesses? Because they don't have the guts. Pets.com's collapse in 2000 marked the end of a brief but impactful journey in the world of e-commerce. The company's failure had a lasting impact on the internet industry, and many lessons can be learned from what went wrong. For entrepreneurs and businesses today, understanding what led to Pets.com's downfall is crucial. One of the most important lessons from Pets.com is the danger of overexpansion without a solid foundation. The company grew too quickly, spending millions on advertising and building infrastructure before they had figured out how to make a profit. They got caught up in the excitement of being part of the internet boom, but they didn't take the time to make sure their business model worked. Today, entrepreneurs need to remember that growth should come after building a strong and sustainable business. Rushing into expansion without thinking things through can lead to disaster. Another key takeaway is the importance of a clear and effective business model. Pets.com didn't focus on creating a sustainable system for generating revenue. They relied on low prices and high spending on marketing, but these didn't create lasting value for customers. In contrast, successful businesses today focus on offering real value to their customers and building long-term relationships. Without a clear strategy for making money, any company is at risk of failure. Pets.com's marketing efforts also provide an important lesson. It's easy to get caught up in the excitement of flashy advertising, but businesses need to make sure their marketing is targeted and effective. Pets.com spent millions on ads, but they didn't build a strong enough connection with their customers to make those ads worthwhile. Today, companies must be more strategic about their marketing, focusing on creating value and solving real customer problems, rather than just getting attention. Finally, Pets.com's story highlights the importance of adapting to changing market conditions. The internet world was evolving quickly, and Pets.com couldn't keep up. They failed to recognize the growing competition and changing customer behavior. Businesses must be agile and willing to adapt as markets shift, especially in industries driven by technology. The fall of Pets.com is a cautionary tale for all entrepreneurs. The lessons from their failure are clear. Build a solid foundation, develop a sustainable business model, create value for customers, and always be ready to adapt. By learning from Pets.com's mistakes, businesses today can avoid the same fate. If you found this video insightful, give it a like and subscribe to my channel for more lessons and stories that empower your entrepreneurial journey.